Why saving money is a trap? Do this instead. What if the most responsible thing you were ever taught about money is actually keeping you poor? Since childhood, you've heard the same advice over and over. Save your money, put it in the bank, build a rainy day fund, be responsible. And so you did. You opened a savings account, you put money in every month, you resisted the urge to spend, you did everything right. But here's what nobody told you. Your savings account is not building your wealth. It is slowly, quietly destroying it. And by the end of this video, you'll understand exactly why and what to do instead. Let's start with the math, because the math doesn't lie. Right now, the average savings account pays somewhere between 0.5 and 2% interest per year. Some banks offer a little more, most offer less. But let's be generous and say yours pays 2%. Now let's look at inflation. Over the past few years, inflation has averaged somewhere between 3 and 7% depending on where you live. Even in a calm year, it sits around 3%. So here's the problem. If your savings earn 2%, but prices rise by 3%, you are losing 1% of your purchasing power every single year. That means the money in your bank account is shrinking. Not in number, the number stays the same, but in what it can actually buy. Every year, your savings buy less groceries, less rent, less fuel, less life. Let's put a real number on this. If you have $10,000 in a savings account right now, in 10 years, at a 3% average inflation rate, that money will only buy what $7,400 buys today. You didn't spend a single cent, but you lost over $2,500 in real value. That is not saving, that is slow bleeding. So why does everyone still tell you to save? Because saving feels safe, it feels responsible, it feels like something a mature, sensible adult does, and banks love it. Because while your money sits there earning almost nothing, your bank is using that money to invest, to lend, and to make real returns. They take your deposits and lend them out at 5, 8, sometimes 20% interest on credit cards. They make money with your money, and they give you back almost nothing for the privilege. You are essentially lending your money to the bank at a loss, and they are turning a massive profit from it. That is not a partnership, that is a business model, and you are on the wrong side of it. Now, I want to be clear about something important. I am not saying you should have zero savings. That would be reckless. Having an emergency fund is essential. Life will throw things at you. A car breaks down, a medical bill arrives, a job disappears. You need a cash buffer for those moments. The general guideline is 3 to 6 months of your living expenses in an easily accessible account. That is your safety net. That is your sleep well at night money. But here is the critical distinction that changes everything. Your emergency fund is not a wealth-building tool. It is insurance, it is protection. Nothing more. Once that safety net is in place, every single dollar beyond it should not be sitting in a savings account. It should be working. So what does working actually mean? It means your money is in a place where it grows faster than inflation, where it compounds over time, where it earns returns that actually move the needle. And the simplest, most accessible way to do that is investing. Now, I know that word makes a lot of people nervous. Investing sounds complicated, it sounds risky, it sounds like something only wealthy people or finance experts do. But that is one of the biggest myths the financial world has ever sold you. You do not need to pick stocks, you do not need to watch charts, you do not need to understand technical analysis or predict what the market will do tomorrow. There is a simple, boring, proven approach that has built more quiet wealth than almost anything else. It is called index fund investing. An index fund is a basket of stocks that automatically mirrors an entire market. Instead of trying to pick the one company that will succeed, you invest in all of them at once. When the overall market goes up, your investment goes up. When it dips temporarily, you hold. And over time, historically, the market has always recovered and grown. The average annual return of a broad global index fund over the past several decades has been roughly 7 to 10%. Compare that to the 0.5 to 2% your savings account gives you. The difference is enormous. Let's look at what that means in real money. If you invest $100 a month into a simple index fund at an average return of 8%, after 10 years, you have roughly $18,400. You only put in $12,000. The rest is growth. After 20 years, you have over $58,900. You put in $24,000. Your money nearly tripled itself. After 30 years, you are sitting on over $149,000 from $100 a month. No special strategy, no insider knowledge, just consistency and time. Now compare that to putting the same $100 a month into a savings account at 1.5%. After 30 years, you would have roughly $45,000. That is $100,000 less than the index fund. $100,000 gone. Not because you spent it, but because you saved it in the wrong place. This is the trap of saving. It is not that saving is bad, it is that saving beyond your safety net gives you the illusion of progress, while inflation quietly eats your future. Every month your extra money sits in a savings account instead of an investment account is a month of compound growth you will never get back. Time is the one ingredient you cannot recover. And the longer your money sits doing nothing, the more it costs you. So here is what to do instead, and it is simpler than you think. Step 1. Build your emergency fund first. 3 to 6 months of expenses in a regular savings account. Easy to access, boring, safe. This is your foundation. Step 2. Once that is full, stop adding to it. I know this feels counterintuitive, but the emergency fund is not a growth account. It is a safety net. You do not keep adding more cushions once the bed is soft enough. Step 3. Open an investment account. Most countries have simple online brokers that let you start with as little as $25 or $50 a month. Look for a broad market index fund or ETF. Something that tracks the global market or a major index. Low fees, no active management. Boring is beautiful. Step 4. Automate it. Set up an automatic monthly transfer from your bank account to your investment account. Make it happen the day after your salary arrives, before you see the money, before you have a chance to talk yourself out of it. Automation removes emotion, and emotion is the enemy of consistent investing. Step 5. Do not look at it every day. The market goes up and down. That is normal. It is not a reason to panic. It is not a reason to sell. Wealth is built over years and decades, not days and weeks. Set it, forget it. Let compound interest do the heavy lifting. Now here is the part that most people miss. And it might be the most important thing I say in this video. The reason most people never invest is not because they cannot afford it. It is because they were taught that keeping money in the bank is the responsible thing to do. They were taught that investing is gambling, that the stock market is only for the rich, that you need to know what you are doing before you start. None of that is true. Keeping all your money in a savings account in 2026 is like putting it in a jar and burying it in the garden. It feels safe, but the weather is slowly ruining it. The wealthy understood this a long time ago. They keep the minimum in savings and put the rest to work. That is not because they are smarter. It is because someone taught them the rules, and now someone is teaching you. But let me leave you with one thought. 5 years from now, you will look back at this moment, and you will either think, I wish I had started then, or I'm so glad I started when I did. The difference between those two futures is not a massive salary. It is not a lucky break. It is one decision to move your money from a place where it sleeps to a place where it grows. Your savings account is not your enemy, but it is not your future either. It is a waiting room, and your money has been sitting there long enough. It is time to let it work. If this shifted the way you think about your money, subscribe, because this is what we do here. We take the things nobody taught you and make them simple. Subtract confusion, add confidence. I'll see you in the next one.